Hello everyone, and welcome to another video on financial analysis. And in this little video, we are going to be looking at a company called 7Digital. So what does 7Digital do? They provide music. So this is a publicly listed company offering access to music tracking and reporting for clients. Okay, they work with things like the fitness centers, for example, and the social media, gaming industries, and they have brands such as Barry's and Triller. So thank you very much to one of our listeners, one of our viewers rather, who asked for this. So this is Gary Smith, who asked to find out a little bit more about this company. So what we're going to do in this video is look at the financial statements of the company. So please do remember to like, share, subscribe to the channel, share this video. We're just going to be looking at the financial statements. We're not going to be looking at the industry in detail. We're not going to be looking at the management team, their history, the opportunities, etc., etc. So if you are a potential investor or you're interested in this from an investment perspective, then you might want to do some additional research as well as this. This is part of the fundamental analysis. Maybe you're a supplier to this company. Maybe you're thinking about joining this company to work for them. Maybe you are just interested in the company. Either way, hopefully this little video is going to be of use to you. Do remember, if you have any videos you'd like us to look at, if you'd like me to kind of look at any particular companies, then please do share those in the comments section. So without further ado, let's jump in and have a look at this business. So here we go. We are looking at their annual report and accounts, and this is available on their website. This is the annual report and accounts for 2020. And we are going to whiz down to page 31. So the first few pages are all about the directors, little comments on the company, the strategy, what they're up to. But we are going to start our investigation with the financial statements, which appear just after the auditor's report. And here they are. So what do we notice? What are the key things that are standing out to me from analysis of this financial statements? So the first thing we see is the revenue. So we are dealing in thousands of pounds. So 9,000 is 9 million. Revenue has fallen from 9 million to 6.5 million. Now that's probably related to COVID. So we'd expect a company like this, if the gyms are closing, then they're no longer buying the services, they're no longer providing the revenue, and therefore these guys are seeing a significant fall in their revenue. We'd expect that, that's no problem. And we'd expect it to come back again after COVID. So maybe this is a post-COVID recovery play. They have a gross profit. So here's their gross profit. And they are operating at a gross margin of 71%. That means for every £1 they bill their customers, it's costing them 30p to buy that music or provide that music, provide that service. Okay, so that's a pretty nice, juicy, fat margin, 70% gross margin. Okay, so that's all looking pretty good. However, we then look at the administrative expenses, and these are very high indeed. They represent 104% of revenue here. So that's 104% of revenue. So they're actually higher than the sales figure, let alone being higher than the gross profit figure. They're higher than the sales figure, and therefore the company is making a net or an operating loss. So there's our operating loss. That's 33% operating loss this year. It was 60% operating loss in the prior year. So if they come back from COVID, we are going to have to hope that their administrative expenses do not rise at the same speed. We also notice from these numbers, just jumping out at us, is this number here. This is the profit from the sale of discontinued operations. So now we don't know exactly why this operation was discontinued. Companies, sometimes they'll say this is no longer part of our core portfolio. It's no longer a market segment or an area we want to be in. That's absolutely fine. Maybe it's just like it's a loss making. We just don't want to be there anymore. We've put enough money into it. We're closing it down. That's absolutely fine. This is the profit from a discontinued operation. The question is, why did they feel they had to discontinue that operation? Have they sold a profitable part of the business? Are they selling the family silver, so to speak, in order to stay alive? We're not sure, but we can hazard a guess. So anyway, the point is that the bottom line, they are making a loss this year, and they're making a loss in prior years. Let's go on and look at the balance sheet. So here we are on the balance sheet. We're starting off looking at the assets. And the assets, these assets here, these are the non-current assets, sometimes referred to as fixed assets. These are the things that we need to run the business. Very little in terms of assets. They've got a little bit of intangibles up here. We might want to go and have a look at note 12 to find out exactly what they're at. That'll be kind of software, I would expect, and you know, apps, for example. Quite a lot of rights of use assets. So what we're showing here is that, you know, they're not buying a photocopier, for example, they're leasing the photocopier. So pretty much all of their assets are leased. They've got about £97,000 worth of actual physical assets that they own, and that's not a problem, you know, especially for the type of company that they are. Let's just go and have a look at note 12 and just see what those intangible assets relate to. So here we are in note 12, and we can see the intangibles. Well, they relate to bespoke applications. So effectively, that's software and apps. And what they're saying is that, you know, we've developed an app, we've paid, we've spent money. Here we are, we've spent a lot of money developing an app, and you know, this now has value to us. The value is going to be recognized over the future years, and therefore we can capitalize that. Now that's a relatively small number. You'll notice that you know, they've kind of the cost at the beginning of the year, they've actually got rid of quite a lot of apps, you know, or disposals during the year, and they've taken out the associated amortization. So net book value 287,000. It's not massive. It was zero the previous year. It was just over £1 million the year before that. And you can see here that they are amortizing it, which is depreciation by another word, over 3 to 5 years. So there's our intangibles. Let's go back to the balance sheet. So here we are back on the face of the balance sheet, and we're now moving on to looking at the current assets. Here are the current assets in here, and we notice quite a lot of trade and other receivables, and also quite a lot of cash. So £2.8 million, nearly £3 million in cash. That's looking pretty good. A pretty strong, healthy numbers. However, not quite so strong when we compare them to the current liabilities. So there are the current liabilities, and if we look at our current assets compared to our current liabilities, we can see that we have some significant liquidity issues. And those significant liquidity issues really relate to trade and other payables. So this trade and other payables is a very, very big number. They do not have enough cash. Even with the trade receivables and the cash, they do not have enough money to actually pay their suppliers. Now, these are some pretty big numbers, and I think we need to go and look at the notes in order to get a better feel for them, because these are kind of, you know, these are some of those key numbers. Especially if you're a supplier or a potential supplier to these guys, you're going to want to know, am I going to get paid? So let's go look at notes 16 and 17 and find out a little bit more about them. So here we are on note 16, looking at the trade and other receivables. So this is, you know, these are, you know, the customers who we sold our products to, and they haven't yet paid. The first thing we notice down here is that the average credit period is about 55 days. Now that seems quite a long time to me. Typically here in the UK, I'd expect to be signing a contract on 30 days, but you know, maybe 60 days. But what does stand out to me is these numbers here. So what we show here is the total amount that they've billed. That's this number here. And then effectively this number here, this provision, is the amount that they've billed. They say we're not going to get back. That is over 50% in 2019. And it is around about 50% in 2020. Now that is a very, very high number. That's basically these guys saying for every £1 they bill, they're not expecting to get 50p. Okay, now that's suddenly, you know, you go back to the revenue, for example, and think, well, if you're making sales of £6.5 million and you're only going to collect £3 million of that, that changes my numbers very, very fundamentally. So this is a major alarm bell. This is a major issue that they are, what credit checks are they doing with their customers? Is it COVID related? No, it isn't, because look, 2019 they were experiencing the same problems. Okay, so what is going on with these guys? What kind of credit checks are they doing before they actually sell the products to their customers? I don't know. Quite a lot of information in this note about the trade receivables, and also quite a lot of information. So here we are, trade receivables. They don't tell who the customers are, but they give you sort of an idea of the kind of the extent to which they're dealing with significant customers. So maybe these are very big customers who have a lot of negotiating power, for example. But again, just looking at these numbers, we can see that of the money that they're owed, a very significant proportion is over 120 days due. And you're kind of just thinking, if after 120 days, are you going to get it? Are you really going to be able to get the money back? What's interesting here is they talk about current and more than 30 days. This would suggest that their standard terms are 30 days. As soon as it gets over 30 days, you're kind of thinking, so basically these are the guys we're confident they're going to pay. These guys, they may be forgotten. We'll give them a phone call. More than 60 days, you're kind of thinking, what, we need to kind of, maybe, go knock on some doors. And 120 days, this is where you're starting to call bailiffs in and debt collection companies. They really need to get on this on debt collection. So there's some issues going on there around their debt collection. Let's look at the trade payables. Interesting enough, the trade payables, and we can work the numbers out for ourselves, but they've actually given it to us. The credit period, the time taken to pay, is 286 days on average, up from the previous year, which was 241 days. So if you are a supplier to this company, you're not going to get paid, or you're not going to get paid very, very soon. So if you are entering into a contract, I personally would recommend that you might want to think about asking for payment up front rather than in arrears. And that is again a very significant number, and we can see that jumping out of us in the balance sheet, that they just haven't got enough. Even if they were able to collect all of those accounts receivable, and they're struggling on some of that, and with the cash, they haven't got enough money to pay their suppliers right now, which means that they need to be generating sales into the future, and this immediately puts the company, they're just behind the curve in terms of liquidity. So they've got major liquidity issues, even though they've got a reasonable amount of cash, and that cash has increased since last year. Let's go back to the balance sheet, see if there's anything else standing out for us. So here we are, we're back at the balance sheet where we've looked at the current liabilities in detail. If we look at the non-current liabilities, we can see there's a little bit of debt sitting on the company, which is new. They didn't have that last year, so that's been taken out. But the non-current liability is relatively low. However, the sum total of all of our analysis is that these guys have a negative balance sheet. So not only have they got negative net current assets, that's another word for working capital, that's the current assets less the current liabilities is negative. You really want that to be positive for a business, unless they've got a specific a business case for it. So this is not looking good, and the actual overall balance sheet is negative as well. And that negative balance sheet reflected in the equity down the bottom. There it is there. So this is why the balance sheet is called the balance sheet, because it balances. And the sum total is to say that these guys, they've raised about £30 million, but they have basically lost it. They've been trading, and they've been trading at a loss, and they are continuing to trade at a loss. And the question is, at what point will they stop trading at a loss and start to make a profit? So not looking too healthy there. We'll come back to the cash flow in a minute, just to quickly look at the movement in equity to see if there's anything kind of going on here. And we noticed that, these guys, they've been making losses, and those losses are effectively ongoing. So there's the retained loss at the beginning of the year. There's the loss during the year. They made a profit on disposal of subsidiary, and there's the retained loss at the end of the year. And that's a fairly consistent message. No dividends for obvious reasons. Let's go to the cash flow and see what's going on. So the top half of the cash flow, you may remember, helps us to turn the loss or the profit, we hope, the profit for the year, and it makes a whole lot of adjustments, i.e. non-cash adjustments, and turns it into the cash profit. Well, these guys, not only are they making an accounting loss, they are also making a cash loss. And exactly the same in the previous year, an accounting loss and a cash loss. Now, this number here, this cash figure here, this is absolutely crucial. So this is a really, really key number. In fact, this is the kind of the one number to be looking at. Is the company generating cash? Because if you're not generating cash, you're burning cash, and you can only burn cash for so long before you go bust. So these guys are burning cash, and they are continuing to burn cash. Do they have a way out of it? You might say, well, Ted, look, hold on a sec, you know, the cash burn has gone down, but I would argue that the cash burn has gone down because of COVID, because they're doing less. As they come out of COVID, are they going to be doing more? Is their administrative expenses going to ramp back up again? Are they going to start burning cash again? We don't know. But right now, if we actually look at the amount of money they have in the bank, which is further down the bottom here. So they've at the end of the year, they finished the year with about £2.8 million in the bank. You remember that was the number sitting on the balance sheet. If you are burning at £2.3 million a year, then you've got just over a year's worth of cash left. And if you go back to the previous year and burn at £4 million a year, then, well, you're not even going to make it through the year. And as we noticed, you know, all of that cash here, well, if I'm a supplier and I've already supplied it and I've got an invoice with this company, I'd expect to be getting that cash for me, not for future operations. So what else can we see from here? Investing activities, little bit of investment going on. You know, buying property, plant and equipment, 415,000. The previous year, no investment, and you'll see here they've got the sales. So again, you know, this year we see that they're selling parts of the business. Last year they were actually selling off assets. Maybe there's a reasonable explanation. We don't need that table, we don't need that computer. Or are they selling assets? Are they selling the family silver in order to stay alive, in order to generate cash, in order to keep going? And then finally, we've got the financing activities. That's these numbers down here. And what do we see going on? Well, the financing activities are really through the issue of shares. So this is a company, it's issuing shares really to stay alive. And the question is, can it carry on? So there's a couple of flags coming up here that suggest, you know, is this company really a going concern? And also, you know, how dependent are they on the continuing issuance of shares to survive? Well, let's go and have a look at page 24. So on page 24, we get the auditor's report, and the auditor's report, they do actually identify this going concern, and they say there is a material uncertainty relating to the going concern. And by going concern, what we mean is, can the company trade and continue to fulfill, meet its financial obligations as they fall due? Can it continue to trade? Remember, if you are director of the business and the company is no longer a going concern, then you are not allowed to trade. It is illegal to continue to trade, and you have to cease. Anyway, so the auditors say, you know, the directors are aware of this. They've mentioned it in note 1. We're going to have a look at that in a minute. And as far as they're concerned, they've signed off the accounts to say that if the directors are happy, then we're happy. Don't forget, it's the directors who have to make that decision. The auditors are merely forming an opinion on that decision, and the accounts are prepared on the basis of a going concern. So let's go and look at the director's comment in the note. So this is actually on page 37. And if we go to 37, here we go. So so there's a lot of information here about a going concern. So if you're interested to kind of read through that in detail, you can. I'm just going to pick up a few comments from here. So they talk about stress testing. I think the real key here is that the group's 2 major shareholders have confirmed their financial support for 12 months. on the date of signing these financial statements. So they've confirmed. Now, there's no legal obligation. They're just saying that, we will stand by the company and we will continue to kind of, provide additional funds to that company to allow the company to manage its working capital, taking account plausible worst case scenarios, etc., etc., etc. And this has been represented to the director of support from the two major shareholders. Now, who are the two major shareholders? Who are these people who are providing the support? Well, I don't know exactly because they're not named, but I can hazard a guess. And the guess I'm going to make comes from the director's remuneration report. So if we look at the director's remuneration report, and here it is, we can see how much they're actually being paid. Now, a few key numbers here. So the total remuneration that is paid to the board of directors is £317,000. So this is quite an expensive. The chief executive is getting £240,000 as a basic salary, plus some share-based payments, plus a bonus, plus a pension contribution. It's costing 300. Sorry, my mistake. Last year 316,000, this year 643,000. That's nearly, we're getting onto the sort of, starting to get into this kind of the £1 million mark here. So £358 million to the chief executive, up from last year on £205,000. That's expensive, for a company that's making a loss. And we can see we've also got the other executive is being paid, but he is actually being paid through a consultancy business. So he's not actually employed by the company. Whereas Langworthy is. Now, what's also interesting on this page is these numbers here, which show the number of shares. So what we see here is that a very significant number of shares are owned by the directors, and on a sort of back of an envelope calculation, we're looking at anywhere between 30 and 40% of shares are owned by the executives, whether they are the non-executive or the executives. So these are very significant investments in the business. And what we're seeing here is that also what I noticed was that the number of shares between this year and last year didn't increase. So you remember that this company has funded itself through issuing shares, but it hasn't funded itself by the directors taking up those shares. Okay, so the directors are not the buyers, so it's other people who've been buying those shares, and they are buying into whatever story these guys are telling us. But for me, if the company goes to the market and says, look, we need some more money, we need to issue some shares, and the directors are not actually taking part in that share issue, I kind of, I scratch my head and I wonder, why would they be doing that? Now, they're not selling their shares, and that's maybe a good sign. Maybe you think, that's absolutely fine. Maybe they've run out of cash, although, if I was paid £358,000 a year, I reckon I could probably stick my hand into my pocket a little bit. And you'll notice here that Langworthy, he's got lots and lots of share options sitting here. And again, quite interesting to look at, what's happening with those share options. There's a little bit here that talks about he did actually forfeit some of those share options. So he actually, didn't exercise some of them, and you're suddenly thinking, well, why would somebody not exercise the share options if they have, complete faith in the company? So there's, I may be talking out of turn here, and I may be sort of, putting a few noses out of joint. And if you want to put me right, you are more than welcome to do so in the comments. If you please do it in a sensible and in a nice polite manner, that would be fantastic. But I just, this company, it's looking, I'm not convinced by by some of these numbers. So let's look at the share price, and here's the share price ever since it floated. So it floated back in 2000 and whenever it was, and it's, obviously there's a big story behind it, the sort of, coming off the dot-com boom, actually, interesting enough. So that'll be the dot-com boom in here. the kind of the TMT bubble, if you remember. It came right off, and then ever since it's just been going down and down and down and down and down. So that's a very historical, long historical view of the company. Probably better to look at it on a slightly more kind of recent level, and here it is. So you know, I've just looked at it a 1 year, and in a year it has, again, it's, you know, it's continuing to fall. The market cap right now, nearly 20 million pounds. Don't forget the balance sheet is negative, so it's kind of like, you know, it's actually you know, sort of 22 million pounds of inherent goodwill in there. There's no price to earnings ratio because there's no earnings. It's loss making. It's been loss making for, you know, quite a while, as far as I can make out. Negative yield. It's you know, it's valued on 3 times sales, if that means, you know, anything to you. So yeah, you know what, it's put it this way, it's not for me. And if I was a supplier to this company, I would be looking for some pretty strong contracts. I'd be looking for payment up front. If I was a buyer of this company, I'd be thinking, oh, that's great, I can buy with that. Actually, no, of course you've got to fulfill your fill your financial obligations under your contracts. But you know, I'm hoping that, you know, the executive have a good story that sits behind this, that they have, you know, a clear roadmap out, and that they, you know, they can show how they can increase the revenue without increasing their administrative costs. They can keep those under control. If I was working in this company, if I was an employee in this company, you know, you want to keep your eyes wide open. Okay, this is a company which is financially struggling. I'm not saying that it's going to go bust, but I'm saying it's financially struggling. It requires shareholder support. If it doesn't get that shareholder support, then it will experience a very, very hard you know, game over, effectively. So there we go, 7Digital. Hope you found that a useful analysis, you know, quick potted look at the financial statements. If you do have any insight on the company, if you've got any comments you want to make, then please do, you know, politely tell me where I've gone wrong, or what I've missed, or why that this is a great opportunity, a great company, or you know, do leave any other comments in the comments section. Thank you very much. Don't forget to like, share, and subscribe to the channel. Lots more, and if you've got a company you want us to look at for whatever reason, then do let us know, and maybe give us the reason as to why you want us to look at it. Maybe you're an existing investor, potential investor, maybe you want to work with them, maybe you want to supply to them, maybe you want to be buying from them, you want to put them in your supply chain, for example. You just want to make sure that they're financially sound. So anything like that, then please do let us know, and I look forward to seeing you on the next video.